The market doesn't care about your opinions or your tips or your favorite TV expert. It only rewards one thing: participation over time. And that's where equity index funds quietly dominate. An equity index fund simply tracks an index. No guessing, no stock picking. If the index rises, you rise. If it falls, you fall. Brutally fair, completely honest. Over long periods, 80 to 90% of active funds fail to beat their benchmark. Costs kill compounding. Time favors discipline. Index funds don't try to be clever, they try to be consistent, and consistency wins marathons. These track India's largest and strongest companies, the backbone of the economy. Think of them as a default setting of equity investing. Return profile: long term average 11 to 13% CAGR. Volatility moderate, best for core portfolio. Large caps don't sprint, they survive recessions. Slow, stable, reliable. Return portfolio: long term average 10 to 12% CAGR. Volatility lower than mid and small caps. Best for conservative equity investors. The waiting room of tomorrow's giants. More volatile than Nifty 50. Historically higher returns with sharper falls. Return profile: long term average 12 to 14% CAGR. Volatility high. Best for growth oriented investors. Mid caps are ambition with anxiety. They grow fast, they fall hard. Time is non negotiable here. Return profile: long term average 13 to 16% CAGR. Volatility high. Best for long term SIP investors. This is equity on hard mode. Massive upside, massive drawdowns. Weak hearts need not apply. Return profile: long term average 14 to 18% CAGR, very uneven. Volatility extreme, best for small allocation only. Sector funds are cycles on steroids. When they work, they fly. When they don't, patience gets tested. Return profile: returns, highly cyclical, can range from 5 to 20% CAGR over cycles. Volatility very high, best for tactical exposure. These focus on companies that pay consistent dividends. Less thrill, more cash flow comfort. Return profile: long term average 9 to 11% CAGR. Volatility lower, best for income focused investors. Every stock gets equal respect. No over dependence on giants. Higher churn, higher volatility. Return profile: long term average 12 to 14% CAGR. Volatility higher than normal indices. Best for diversification seekers. Rules based investing. No emotions, just math. Return profile: returns index dependent 11 to 15% CAGR historically. Volatility varies by factor. Best for advanced investors. Global exposure reduces home bias. Different economies, different cycles, same discipline. Return profile: long term average 10 to 14% CAGR, currency adjusted. Volatility moderate. Best for geographic diversification. Ultra low costs, no fund manager risk, transparent portfolios, perfect for SIP, tax efficient over long term, no hero worship, just process. No downside protection. You will experience crashes. Average returns by design. Requires patience, not excitement. This is wealth building, not entertainment. Index funds are ideal if you think long term, believe in discipline, Prefer sleep over stress. Respect compounding. SIP plus time plus index equals wealth. Index funds won't impress your friends, but they'll impress your future self. In a market obsessed with speed, choose endurance. Stay invested, stay boring, stay wealthy.